Good morning, traders. It is Tuesday, the 13th of January, 2015, 8:02 a.m. Chicago time. As always, thanks for joining. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations subject to change without notice. Past performance is not indicative of future results. Quick rundown on the driving news. A summary by TradeTheNews.com says European equity markets opened lower following Monday's gains amid declines in the U.S. and lower oil prices. Markets later pair losses amid inline UK core CPI data. A cautious outlook weighs on Philips, German retailer Metro Q1 sales above estimates, and lower oil prices continue to weigh on energy firms. Oil is getting hit again. Currently trading at 45.10 on the February contract. China's overall 2014 trade growth comes in below the official target, almost half of the official, below half of the official target of 3.4% versus 7.5% expected. That's big. Sees pressure continuing in Q1. BOE's Carney says inflation is lower than expected, but no need for more money stimulus could keep interest rates at record lows for a bit longer rather than more QE. Now recall the UK, or the Bank of England, was expected to be the first in a series of banks that would start increasing interest rates, and it doesn't look that way. It looks like they're going to hold things where they are. I'm sure the price of energy is putting pressure on inflation, and so they have to extend things out. S&P fair value negative 6.4 points. Looking ahead, at 9 o'clock, 30 minutes after the open, we have the January IBD tip economic optimism expecting 48.3. That's at 9 o'clock Central. At the same time, we have November JOLTS job openings, 4.83 million expected. At 10:30, Treasury to sell 4-week bills. At 11, we have the DOE short-term crude outlook, which I have not seen come out before, but it's making it onto my calendar here. 11 o'clock, DOE short-term crude outlook. Also at 11 o'clock, ECB's Nowotny's in Austria. And as to comment, at noon, we have December monthly budget statement, expecting 3 billion versus 38 billion prior. Also at noon, we have a Treasury to sell 21 billion in 10-year notes reopening. At 1:30, ECB's Lint in Spain. And then at 3:30, we have the weekly API oil inventories. This is different than the oil number that comes out tomorrow at 9:30 Central. At 4 o'clock Central, we have Fed's Kosher Lakota speaking on the economic outlook in New York. So I'm sure we're going to see comments from that. And then this evening at 9:45 p.m., Japan's to sell 30-year JGB bonds. Again, looking at the rest of the week, recall that tomorrow we have a busy week with earnings. We have JP Morgan and Wells Fargo tomorrow for earnings. Let's look at the technical picture now and see what we expected yesterday versus what we did. So looking at yesterday's action, the expectation was for the market to pull back to 28. Expected the market to stabilize actually in the range that it had made between Thursday and Friday. Thursday and Friday, when we overlap the 2 days, we have a double distribution profile. Hard to see here. Let's switch this over into solid blocks. You can see this double distribution with the cutoff line at 44.75. And I had suggested yesterday that buyers would have to take and hold 44.75 to take another stab at 60. The big picture, if you're looking at what's happening here as far as the big picture is concerned, the big picture is that we are battling in between two key areas. Let me redraw this profile. And I'm going to show you how if we zoom this out, you'll see this more clearly in a second. This is what we're doing. We are basically battling in between two very large areas of volume. Yesterday, we managed to push through to 2015. 2015 comes from the shorter term profile, and I'd called it out for yesterday as a key area below. Man, it's a lot of information. So 2015, comes from the drop all the way down to 84.25, and then a pullback to 2061. Remember, 2060 is key in this area. Very, very big number up top. And 2015 is the point of control given the action that occurred at the bottom here. In fact, if I just reduce it to what it is for this area that we fell back into, we filled the gap. So the question is, we have these overlapping days. Once we filled the gap here, the question is, what is the most valuable price in this balance zone? And we find 2015 yesterday. So the 2015 is the point of control, the MC point of control. And then yesterday we pushed right to that and missed by a tick and held that price. Retest on the close, did not quite push it there. Something to note, the initial balance, which is the first hour's high and low, yesterday was not breached. The probability of that occurring, given a 1,400-day sample size, the probability of that happening is around 2 to 3%. So the expectation was for a pullback, and I actually, believe it or not, I actually expected this to break higher and take a lot of the morning sell-off back. It was not able to, but it also was not able to do the next leg of this impulsive move down. Very strong drive lower, an open test drive opening, and then it could not extend that. Range lower against this 2015. But what we've done is we've tested the lower balance area. We've tested the upper balance area, this other black line here. You could see it here on the composite as the most traded price in this area. So we've tested that by 4 ticks. We've tested below by a tick. The market clearly is trading under the intermediate time frames control. These numbers come from multiple days, so that introduces the idea that the intermediate time frame is in control. I'm still looking for a return to 41, a test to 44.75, and then a push to 53. With the overnight, the way it's shaped up in the overnight, it looks like buyers are stepping in. We pushed on the overnight down into the yesterday's day session point of control, and buyers stepped in, and buyers stepped in again. You can see the delta is following the buy side, so it's not just price moving, it's price moving on volume. Some divergence here between price delta and volume delta, but it's not something that I trigger off of, so it's not something I can comment too much about. But in either case, it looks like buyers are stepping in early today. Price is pushing right up against the overnight high, and we've taken back the stem, which is, like I said, which is what I expected in yesterday's session. Once this we got back to the mid. If you look at how the market's moving, now this is going to look like a bunch of spaghetti, but if we go back to this move that occurred in oil early on, so right here at 950, this black line, if you follow this black line, this is crude oil. This chart is simply charting that day's percent change from zero at 8:30 Central, which is the open of the stock market. If you look at how, so this keeps me informed as to what the different sectors and the different key components are doing. So I've got treasuries in here. The 30-year bond, U.S. bond is U.S. The 10 years TY. Japanese yen. Gold is up here. QGC. The Bunds BD XG is DAX. EX is Euro stocks. The transports TranX. TFS is the Russell. XLI is the industrial select sector spider. So that's tracking the industrial sector in the S&P, which is a large component. XLV is the healthcare. XLY is the consumer discretionary sector, and so on and so forth. XLK is the techs, and so on. And so what this tells me is what is the relationship between these. And if we look back at how the market's reacting to oil, and that's my point, there seems to be a higher and higher correlation between it. We had the DAX and the Euro stocks here, this light blue and brown, responding very strongly and getting positive since the Wall Street Open on the pop in crude yesterday. But you can see that all the indices are responding to crude now with a higher and higher correlation. This started about 2 weeks ago, and it seems to be persisting in that the market's actually following what crude is doing. And given that crude is down again today, I'm just keeping a close eye on how that relationship's playing out. What I'm not suggesting is that we look at crude and take trades in equity indices based on that information. That's not what I'm suggesting. I'm just saying that the market's getting heavily influenced about what's happening in crude, and I think rightfully so. Today, opening at the stem, and I call it the stem just back from my market profile days, which I don't use much. It's opening in this excess high. Excess high meaning an unfair high. These are prices that the market opened at yesterday and immediately rejected as too expensive. Okay, and what we're doing is we're coming back and trading those prices. Currently, we're trading 2036 quarter right here. We're right in the stem. This means that the market is rejecting where value was yesterday, and it's likely to start exploring prices higher. So it's not that simple though, because I believe that there's going to be a responsive component because the inventory, the overnight inventory, is likely to be long and it's likely to rebalance. So on the open, I'm looking for a quick test of the overnight high. I'm looking for responsive selling to attempt to hold prices down. But overall, it looks to me like 2041 is the first target. Buyers need to take this 2044.75 or so. If they successfully take 2044.75, that brings 2060 back on deck, and now we're starting to attack the higher prices left behind from before and potentially new highs. What the market does today is very important to me. I want to see how the auction goes. If the market on hypothesis number 2 or plan number 2, if the market pushes the overnight high to yesterday's open at 2040 and attempts to get out of yesterday's range but falls back in and starts moving down towards 2022, which is what hypo 2 is, we're looking for new lows. We're looking for a continuation of this impulsive move and this retest failing, and we're looking for 2015 to give up And now we're starting to tackle prices below, the key of which is 99.50, 95 for point of control, and then the main price down below is this 84 quarter, which happens to be the low. Note that 84 quarter was also the high volume node to the tick, which we held last week. So if that happens, I'm going to start looking at a bearish slant on the market. This is setting up a bearish kind of play in the intermediate term. Let's get rid of this profile. So what we have is new highs on a weak high, market drops, puts in a higher low, attempts to take back the high, cannot take out the 60 area, and then puts in a lower high. And so now I'm looking for a lower low, and I'm looking for an exploration down below and into the 1980, 1984, and then start looking at 1956 quarter, and some of the areas below the mid of this entire swing is 1947.50. That's what puts that on deck. So today is pretty important to me. I want to know which of these distributions the market's going to hold. It's trading 2036, and you can see it's trading in between the upper distribution and the lower distribution, which was tested yesterday and has held, but it held on weakness, and it didn't continue through overnight. Barring any news, I expect that the market's likely to start creeping back up and retackling this 2060. If it does, it'll put in a weak high. It'll likely put in a weak high, and then it starts to bring this new all-time highs back on deck with a higher probability. If it fails to do so and starts to move back below 2018.50 and towards 2015, then I'm looking for much lower prices in the shorter term. That doesn't mean I'm bearish. I don't hold a strong opinion, bearish or bullish on the market. I'm just looking short term because that's my forte, but that's just the way things are looking right now. I'll leave you with that. Good luck, and I'll catch you tomorrow. Take care.